You know, it's been such a topsy-turvy week in the markets. We wanted to get perspective from David Rosenberg, chief economist and strategist at Rosenberg Research and Associates, who joins us now. Rose, before we get into the markets, we've been covering this breaking news this morning about the resignation of Mark Machin. You know, I don't want to lose sight of the fact that this pension fund has more than $475 billion in assets. I mean, just as someone who's very deep into the markets, do you have any reaction to a sort of a change at the top like this?
I don't think that there's ever been a situation where a change for whatever reason at a major pension fund or financial institution, has really changed anything. So I realize that, it's maybe politics as usual or not as usual, but this is going to be a front page story for a day, and it has no material impact, at least on what anybody's view is on the economy, the financial markets. This is tempest at a teapot.
Well, let's get into it, because I mean we're at this very heated moment in where we go from here. You've been watching every minute of it. How would you characterize the state of the markets right now?
Well, look, we've got this temporary dislocation that's coming out of the rates market, and if you go back to March of last year was the last time we had a temporary blow up in treasuries and liquidity problems that seeped into other markets. And at the time, the view was that the Fed was not getting sufficiently ahead of the curve as far as the pandemic and the implications it was having on the economy and on the markets. And then the Fed, of course, on March 23rd, did more than just get ahead of that curve. So I think this is temporary dislocation in the marketplace. In a more fundamental basis, I would say that, what's the bond market telling you here? We've had really a double whammy in terms of real interest rates becoming less negative. At the margin, they've been going up because of the view that we're going to get this big fiscal package in the U.S., not at a time when the economy is in disarray as it was during the CARES Act. But the vaccinations are rolling out more quickly. We've had a precipitous decline in the case count, and people are wondering, do we need 1.9 trillion right now of additional fiscal stimulus? So that's having an impact on real interest rates. Then, of course, you got the inflation expectation aspect of it, too. A lot of it stemming more from supply disruptions and supply chains and related to commodities and semiconductors. But you've had these two factors. Of course, it really hit home this week, I think, in part because Jay Powell, I don't think, did a sufficient job in addressing why he doesn't see inflation as a problem. And so I think the markets weren't really quite clear on his messaging, even though he had the opportunity twice this week in front of the Senate and the House. So there was that aspect of it, too. But bond yields right now are just reacting, obviously very quickly, but to real interest rates, fiscal stimulus, and inflation expectations. And that's why the bond yields ratcheted up as much as they did, and why every other asset class that's priced off of the bond market reacted accordingly.
So just to dig a little deeper into your own personal view, because the bond market message seems to be stimulus isn't just working, but there is this risk of overheating. You addressed sort of the reaction to Powell's comments this week. How concerned are you, or how much action do you think the Fed has, beyond just addressing those issues? I mean, this conversation around rates rising, does the Fed have to be more forceful on that front?
Well, I think the Fed maybe has to improve its messaging, less to say to the market like James Bullard did, that we're just fine and dandy with inflation going up. I don't think people really want to hear that. They want to hear why your policy is calibrated appropriately for the outlook. My perspective is this. People just can't see past the tip of their nose. They're getting all excited because the Atlanta Fed takes its first quarter GDP numbers above 9%. Look, we got numbers today in the U.S. in January, personal income and consumption. If you strip out government transfers, because of course we got that really big one, another one's coming at the end of December, personal incomes in the United States outside of government handouts has been negative now for 3 months in a row. And that's your vitality in the U.S. economy is vaccines and policy stimulus. Now, I think that for this year, it's going to be a very strong year for the economy. But I'm more concerned right now. And look, if the markets are forward-looking and forward-looking, say, 3, 6, or 9 months, we have to start looking at 2022. At some point, the markets will be forced to confront 2022. And what I've been writing about is the looming fiscal cliff. Because all this fiscal stimulus everybody's talking about, this is not like, FDR, New Deal stimulus over a 5-year period, capital projects. This is not permanent tax cuts by Ronald Reagan or George W. Bush or Donald Trump, or even, say, the 10-year infrastructure program that Obama brought in back in 2009. This is all temporary. And it's going to all come out. Like, think of what a $2.8 trillion fiscal withdrawal is going to mean for the U.S. economy and the global economy in 2022. So I'm trying to stay ahead of the curve. Everything we're seeing right now is transitory. It's not permanent. The impairment to supply constraints and production schedules, they will catch up to demand. I don't see inflation being a permanent problem. Could be a temporary problem, not a permanent problem. What people aren't factoring in is that everything we're seeing right now is temporary. And even the increase in inflation is temporary. So I'm actually looking at this increase in bond yields, the sell-off in the Treasury market, as being a very attractive opportunity to get back in.
Let's just finish on that note. Maybe you can shed some light on what your advice to investors on positioning for that sort of trend over the next year or two should be.
Well, I think that you certainly want to be diversified, and you want to be geographically diversified, and you want to be focused on areas of the world where there is value in their markets and where the vaccination process has been at a very strong rate. I mean, there's parts of the world that look very attractive. I'm not talking necessarily just about Israel, which is not the most liquid market in the world, but say the UK looks very attractive. India is looking very attractive in that regard. They seem to have herd immunity. But if you're looking at sectors right now, look, I think that in the value proposition, I still like energy and banks. I think that's a good place to be. But I'm looking right now at bond yields. Finally, you're offering some competition to the dividend yield, and I'm in the disinflation camp. I'm not in the inflation camp. The market right now actually is starting to price in the Fed starting to raise rates this year, which I find preposterous. So you have a lot of bad news, or maybe too much good news from a macro and inflation standpoint in U.S. Treasuries right now. And that's where I'm focusing my attention. I think that that the long end of the Treasury curve right now is looking extremely attractive to me.
David, always good to get your insight. Hey, thanks for making time on this Friday morning. Appreciate it.
Thank you. Take care.
David Rosenberg, Chief Economist and Strategist at Rosenberg Research, joining us.